Right. Good afternoon. My name is Jason, and I'm here with my colleagues today, Laura, Irene, and Ming. And today we'll present to you a case study on the losses in the currency option team at National Australia Bank in 2004 as a result of the poor risk management. To start off, I'll give you a bit of background. Specifically, I'll talk about how these traders obscured the portfolio by a practice called smoothing, which is essentially just a euphemism for fraudulent behaviors. And then we argue that this smoothing practice and other misconducts arise from underlying risk management issues to which we propose corresponding controls to them. And then finally, we will propose a few dashboards to monitor these risks and end with some key takeaways. Now, to understand what happened at NAB, we first have to realize that there were structural loopholes at the bank that allowed for the manipulation of trades. And there was also an overarching culture of non-adherence to proper risk management, both of which led to the practice of smoothing. Because of the different time zones that NAB operates in, there exists a 1 hour gap, 1 hour window between NAB's end of day close, where all the transactions and profits are recorded, and the time when the back office actually comes in to reconcile these transactions. So as a trader, you can take advantage of this by simply posting a profitable but a false transaction just before the end of day. So all the profits are recorded, and then you correct it during the 1 hour window after that. Needless to say, this act of smoothing has had serious risk implications for NAB.
To discuss the impact of smoothing, we will look at this from three angles. First of all, from a business perspective. Since the true financial condition is being concealed, it can mislead NAB to set an inappropriate business strategy in a way that, on a general level, it can cause the business to misallocate capital and resources to each business line. And on a more granular level, each business line or unit might not be able to make their own optimal and risk-informed decisions. In addition, employees in this case are also not being fairly compensated or even penalized for their performances. On the reputational side, their smoothing activity will significantly hurt the bank's credibility and reliability to all relevant stakeholders. And lastly, NAB's size is also large enough to disturb the integrity and fairness established by the local regulatory agencies in the financial system, and ultimately hurting investors' confidence in the local financial market. From risk management perspective, incorrect performance information also leads to inappropriate choice of hedging strategy. Since the actual asset return are manipulated, the asset correlation is in turn distorted. Therefore, conducting hedging using distorted correlation, there's a chance that not only it wouldn't help to control the risk, but instead magnifying it. And in addition, smoothing will also deteriorate the corporate risk culture in a way that implicitly signaling all the other employees the bank is tolerating dishonest and deceptive actions. And from a third angle, NAB should also be prepared that regulators will raise their capital requirement. To have a more accurate sense of the size of this impact, we estimated the additional amount of capital requirement in two possible scenarios using two different approaches. So we went back into the context of this case, which is 2003, and followed the 1996 Basel I amendment accordingly, which required banks to keep a market risk capital for their trading book based on a value at risk measure. So for approach one, we first intended to bring things closer to the reality and calculated the VaR using the actual market rate rather than their smoothed off market rate. And to support that, we made a few simplifying assumptions. This includes assuming their positions all net sell to a short at-the-money call in US dollar, and we also assume the portfolio's time to maturity is 1.67 years. And of course, a few others. And based on these assumptions, we conducted historical simulations using the 2003 spot rates. And from there, we were able to calculate a 10-day 99% VaR of 91.81 million, leading to a total capital requirement of 275.43 million instead of their reported capital of 66.41 million. However, going forward, regulators are likely to be even more conservative in the period following this scandal. Therefore, we came up with the second approach, representing one possible scenario that regulators may require NAB to add back the entirety of the overstatement in their currency option portfolio. So to the currently reported 66.41 million, If we add back the overstatement in the most extreme case of 360 million, it yields to a capital requirement of 426.41 million. But in both cases, going forward, there will be a drastic increase in NAB's regulatory capital requirement. Therefore, this made us thinking, what are some remediations to these problems? And lead us to comprehensively scan through NAB's issues and came up with corresponding controls to each of them. First of all, the culture of NAB is definitely liable for fostering employee conduct issues. The business lacked transparency between and even within each department, which allowed the traders' misconduct to persist for such a long time. So we would suggest NAB to build more communication channels. It could be work-related to help fix the information asymmetry issue, could also just be casual ones to shorten the social distance between people. And aside from general communication, whistleblowing is also an important source for risk detection. In NAB's case, if the problem was raised earlier, the size of the loss would also be much more manageable. Therefore, we suggest NAB to set up an anonymous whistleblowing hotline immediately directed to the risk management or even the CRO. And along with that, define a whistleblower reward policy and just pass this information across the organization. This will not only incentivize the day-to-day peer monitoring, but also deter employees from attempting unethical behaviors in the first place.
And in addition, we believe a culture of integrity should be promoted to avoid a business environment that fosters unethical behaviors and risks. So now back to NAB's story. Its good news only culture encourage manipulation and discourage timely escalation and corrective actions. Thus, NAB should set proper tone at the top that holds an open attitude toward bad news, as well as continuously reinforce the employee's code of conduct through methods of trainings or during meetings. The consequence and penalty of serious acting in breach should be broadcasted to all employees to discourage them from crossing the line in the first place. And to incorporate such culture of integrity into employees' day-to-day decision-making, the performance evaluation should be based on not only revenue being generated, but also the risks that are undertaken, such as risk exposure, as well as employees' compliance to code of conduct and their long-term performance. And to avoid short-term profit manipulation, the bonus could be deferred or spread out over 3 to 5 years to discourage such motivation. We also believe a robust and well-rounded risk governance framework serves as the backbone for efficient risk management. As in the case, although the strategies were said to be focusing on customer-based income, the option trading desk was still focusing largely on proprietary trading, indicating misunderstanding of strategies among employees and led to such a huge loss. Therefore, tailored business strategies and corresponding risk appetite to each line of business should be clearly defined and actively communicated through the various communication channels. It is important to make sure employees' interpretation of the defined strategies are unbiased and that goal congruence can be achieved firm-wide. And in addition, enhancing risk ownership and risk awareness throughout the firm could also improve the governance efficiency, and this can be achieved by building the risk and control self-assessment into the standard practice for each department to follow. And other controls, such as strictly policing its risk limits by penalizing all active breaches, should also be in place. Another important improvement on NAB's governance is to enhance its corporate structure. Currently, NAB has a culture and structure where risk management responsibilities are passed instead of assumed. For example, the risk management team are fully aware of the persistent limit breaches, but took no action into further investigation or escalation because they didn't take that as part of their responsibility. Therefore, we believe NAB should ensure concrete definition of responsibilities to risk management in place for all 3 lines of defense, as well as having a clear delegation of roles and objectives for employees endorsed by the upper level. And full authority should be given to make sure corresponding personnel have the power and capacity to do what they have to do without being disturbed. And also the structure should enable segregation of duties and emphasize the disclosure on conflict of interest. And to further demonstrate NAB's altitude and determination toward mitigating employee misconduct and achieve a more efficient governance framework, we propose establishing a People and Conduct Risk Committee specifically to mitigate conduct risks. And they will be responsible for the monitoring of conduct risks, including review and approval of the conduct risk policy, code of conduct, risk appetite, RCSA, as well as KRIs. And now move on to talk about resilience. The impact from the scandal actually came in many folds, including but not limited to business disruption, corporate restructuring, and global operations scale back. And this signaled the importance to have a robust resilience action plan in place. So first, it should enhance its business continuity plan, including prioritizing recovery objectives for critical operations and specifying detailed responsibilities for all stakeholders and conducting thorough business impact analysis of plausible scenarios. It should also make sure to have enough capital reserve to deal with unexpected loss events by setting aside sufficient capital determined by regular stress testing and scenario analysis. Moreover, NAB should ensure a thorough understanding and full consideration of interdependencies, both internal among business units and external with counterparties or third parties, when set up the business continuity plan.
The absence of financial controls and gaps in back-office procedures also led to the repeated limit breaches and resulted in falsified transactions in that 1 hour window. So NAB needs an enterprise platform that integrates all the system and record employee actions. There should be a securities management function in the integrated platform so that the company could set up different employees with different access levels to prevent backdating and system misuses. And end-of-day entry cutoff will also discourage amendments to those false trade details. Besides, the platform should record and reconcile internal transactions to avoid the fraudulent internal trades. The currency desk also check with the trade repositories and major counterparties to verify external trade details. All these backend measures would prevent manipulation in that 1 hour window. The backend platform should also include a conduct risk model to detect suspicious trading patterns based on past loss experiences, historical trading data, and peer group comparisons. The backend system should automatically flag suspicious behaviors, and then a flow system can issue warnings and notify risk management, even if the immediate supervisor approved the breaches. We have included many suspicious trading indicators in our operational risk dashboard. Besides, inadequate monitoring process has caused the currency options and risk management team to routinely underestimate their risk. So the trading desk should actively monitor key risk indicators, including desk and firm-wide Greeks. For example, each trading desk should maintain close to daily delta neutrality, and the firm should comply to limits on other Greeks, such as gamma and vega. They should also monitor the stress and normal VAR and ES, and they can incorporate the volatility smell in the VAR and ES simulations. And they should update their asset variance and covariance matrix periodically because this will be used to calculate all the risk measures. As mentioned before, traders are tempted to take risk to beat the target, so it's crucial to strictly enforce the risk limits to control the excessive risk-taking. The currency option desk should also review their concentration on counterparties, assets, and maturities. And they can monitor dependencies with counterparties and across business lines through a regular business mapping exercise. These measures will effectively prevent the currency desk from accumulating large positions on a particular asset and against a certain group of counterparties. To give more color to the KRI monitoring and supervision, we propose a performance and risk dashboard for option market makers. And this is the full dashboard. And to evaluate their performance, we first visualize their market share by their contribution to the overall liquidity of the market, measured by their trading volumes as a share of open interest on the top. And in the bottom two charts, we also look at their P&L, and we try to decompose it into fee, commissions, and rebates, and others. And they should also express their P&L in terms of Greeks to understand the composition of profits. And in addition to the portfolio's daily Greek exposures, We also look at comprehensive measures to evaluate risk, such as VAR and ES. And these are compared with their predefined risk appetite, and any breaches will be recorded. VAR and ES can also be divided into their stress and normal versions and by different time horizons to evaluate the added risk during volatile market conditions and across time. We also look at concentration risk in terms of their set of the market, average inventory maturity, underlying asset, and counterparties. All these risks are also reflected in the P&L stress test of their most important risk factors. Finally, we observe the implied volatilities, including the volatility smell to the left and the at-the-money term structure to the right, so that we can consistently price options. And implied volatilities should also serve as inputs for risk metrics such as VAR and ES. We also include a volatility chart in the middle to indicate mispricing opportunities to treat implied and realized volatilities.
Okay, so in addition to market risk, we also want to look at the operational risk of a trading desk. So here's a dashboard for operational risk that we propose with 4 different sections. But on the top right, we have the dashboard status, which indicates any issues that they've discovered during an RCSA, and also the general resilience level by their level of capital buffers and the adequacy of a BCP, a business continuity plan. Now, to ensure that these desks are trading in compliance with their business strategy and their risk appetite, we want to monitor their trading volumes and the positions across different assets. For all of these measures, we've seen a lot of them before, but on the operational dashboard, our focus is on ensuring that these risk limits are adhered to. Now, in addition, we also want to look at these measures over time. So for example, on the bottom right, we have the positions across assets and the gross and net positions over time. And on the top, we have risk exposures. So we have VAR and ES, and on the left, we also have the different Greeks over time. And for each of these time series, we want to include their current exposures, any historical breaches in the past, and any approved breaches in the past. Now, for NAB's case, there were also numerous red flags of suspicious trading behaviors that were not properly captured. For example, there were large P&Ls on day 1. There were large trading volumes, large or deferred premium. So as a risk manager, we want to automatically flag them, but we also want to detect other transactions that are either done internally at off-market rates or at entered manually or adjusted after the end-of-day close process, including the trades that were later surrendered during this time. And finally, the currency option desk at NAB was also plagued with a poor risk culture. So as risk managers, we want to look at their extent and the quality of their conduct training. And for example, we want to look at the training completion rate, training test passing rate. We also want to look at their profit targets over time. So for example, consistently meeting or beating the profit targets could be a sign of concern. And then finally, on the bottom, we have our conduct news window that notifies the users of any firm-wide conduct issues. Now, to conclude, here we listed all the different controls that we think NAB should put in place. We ranked each of them based on implementation cost, business impact, and timeliness. The most important change we think should be made is to improve the monitoring and supervision process. And this could be done by incorporating the dashboards that we propose. This is cheap to implement and can effectively limit risk and misconduct before they've had a chance to manifest into large losses. But of course, it's also important to ensure adherence to business strategy and risk appetite, and to develop a proper escalation and whistleblowing channel, and possibly an overhaul of their backend system, integration, and security. And so far, we have proposed a long list of changes. But at the end, we would like to end by reiterating and emphasizing a couple of them. So first off, the smoothing activities of NAB traders left a lasting impact on the bank's business and the risk management.
And when we trace the problem to its origin, a corporation's tone at the top is what ultimately shapes its risk culture and all employees' standard behaviors.
And in addition, we believe business transparency and information symmetry are the fundamental and indispensable infrastructure for healthy and efficient corporate operations, especially for risk management.
And the trading desk should also continuously monitor and strictly enforce the predefined risk limits, even if the traders could make a huge profit from their risky bets.
And finally, we think risk management should really be performed and integrated into all business lines and across the 3 lines of defense. The risk owners themselves should control the exposures, while risk managers and internal audit should serve as an independent oversight to the preceding levels. And with that, we'll just end with this quote from PwC, and we're open to any questions you may have. Thank you.
Excellent. Really well done.